This is Joel Solomon of PRS in the Roadmap talking about the markets 2016. I want to first talk about the importance of long-term focus and compound interest. If you had $1 million and if you were able to get 6.45%, you'd obviously get $64,500 of interest added to your account. If the IRS said no tax, your million would grow to $1,064,500. So you'd have that balance going in the year two. Same rate of interest, because what we're going to do here is assume that we can get 6.45 every year for 20 years. Now we know that it's impossible. This is just an example, and any rate of return we show is just for illustration purposes and no guarantee of results. But if in year two we got the same 6.45, you'll notice our interest credit would go to $68,680, up from the $64,500. That's interest earning interest. Now, if I got 6.45% every year from year 3 through year 10, so in year 10 again, we're getting the same 6.45. That interest credit in that 10th year alone is up to $113,000. That actually means that your effective yield in year 10 alone would be 11.32%. Now, the rate of interest we earned never changed. It was still 6.45. So why is the effective yield 11.32 in year 10? Effective yield is a fraction. The numerator is the amount of interest earned during the year, in this case $113,000. The denominator of the fraction is the original investment, in this example $1 million. So 113,000 divided by $1 million delivers an 11.32% effective yield in year 10. Now what if we continued getting 6.45 every year from year 11 to year 20? What would it look like in year 20? Again, earning the same 6.45. Our interest credit all the way up to $211,000 in the 20th year. What rate of interest did we get? 6.45. But effectively, we earned 21.15% in the 20th year alone. This is the importance of being able to take money, allowing it to accumulate in a tax-free environment where interest is earning interest, meaning compound interest. Some say that compound interest is the greatest mathematical invention in mankind's history. We think it's compound interest without taxation and without principal risk. So how could we possibly get an average annual rate of return of 6.45%? How do we get it to grow tax-free? And can we protect principal and all gains from down markets? So how likely is that? Well, let's take a review of a relationship between certificates of deposit at the bank, bonds, and equities. You see, if you tell me that you think a one-year CD in 2016 is going to pay 1%, a 20-year investment grade bond should yield about 2 to 3% more than a CD. Otherwise, why would anybody take their money out of a CD and buy a bond? You got to get paid more in interest. Now, this interest is paid on a semi-annual basis, and at the end of a 20-year period, if you held the bond, there's the probable return of getting your money back. So to give that up and go into the S&P 500, you better have an expectation of getting 6 to 8%. Because again, you're giving up this interest that you would get in the bond. You've got no assurance that you're going to get any of your principal back because this is going to be volatile. So if you can't make at least 3 to 5% more than a bond, generally people wouldn't move out of bonds and go into the equity markets. So the question is, how likely is a 6 to 8% annual S&P? If we look at 2015 S&P performance, the S&P grew without dividends in a negative manner, minus 0.73%, a little less than 1% in 2015. With dividends, it actually grew by 1.38%. It's rare that the S&P actually goes down in any calendar year, which I'll share with you in a few minutes. So the real question for all of us is, which directions are the markets heading? Will the bull market continue to run? Is the bear market going to come out of the woods? Or are these markets just going to fight each other and go sideways? Now, the S&P over the last 30 years, if we were to look at it, and that is the S&P with dividends, how many down years has the S&P with dividends had? First of all, in the last 10 years, from 2006 through 2015. I wonder how many years you think the S&P with dividends was down during those 10 years. Then you've got the previous 10 years from 1996 to 2005. How many of those years was the market down? And last, if we looked at the 10-year period 1986 to 1995, how many down years did the S&P have with dividends during this period? How would you answer those three questions? Well, you'd be interested to know in the last 10 years we've only had one down market, 3 in the previous 10, and 1 in the 10-year period 1986 to 1995. So looking at the S&P with dividends in this column here, last year the market was up 1.38%. So if we look at the 10-year period of 2006 to 2015, only one down year, the Great Recession of 2008, where the market dropped 37%. This means that 90% of these years, the market was up. Does that surprise you? In the previous 10 years, from 1996 to 2005, we only had 3 down years. The dot-com bubble bursting in 2000, followed by the 9/11 in 2001 in the aftermath. Now, this 3-year-in-a-row run didn't happen. Again, you'd have to go all the way back to the late 1930s to find a 3-year-in-a-row downdraft in the market. But this created as much carnage in this 3 years in terms of loss of market value as what happened in 2008. But again, looking at this 10-year period, 70% of the time the market was up. Now last, looking at the 10-year period 1986 through 1995, again, only one down year in 1990 when Saddam invades Kuwait. Now, the market did drop about 20% during the summer. The Fed moved very quickly. Market only lost 3% in that year. That means in this 10-year period, the market was up 90% of the time. Now again, remember, past performance is no guarantee of future performance, and none of this should be relied upon to predict what the future looks like. But it's something to take special note of, and that is the history of the market. Now, let's look at the average annual rate of return of the S&P with dividends over the last 10, the last 20, and the 30-year period. Now look at this. Last 10 years, average annual return of the S&P with dividends, 9.13%. The last 20 years, average annual rate of return, 9.93. And if we look at the 30-year period from 1986 ending 2015, the S&P with dividends had an average annual rate of return of 11.83%. However, we did have 5 down years during these 30-year period. So what if, when the market went down, what if all principal and all gains would be protected from any downward market movement? In other words, when the market goes down, what if zero was your hero? And what about having an interest rate ceiling of 11%? So for example, the market went down, none of your principal or gains go down. But if the market goes up, like it did in 2013, where the market goes up by 32.39%, what if you were capped at 11%? So a 0% interest rate floor and an 11% interest rate ceiling based on the growth of the S&P without dividends. Well, the average annual rate of return over the last 10, 20, and 30-year period of time, as you can see, is between 6.8 and 7% per year. Wondering whether or not you're surprised by that. And last but not least, we could take an approach of getting interest on money in the market if we followed a theory of where we would invest money. The interest floor again was zero, so all principal and gains are protected from a down market. But if we took the growth of the S&P times 150% and had a ceiling of 9%, so for example, if the S&P grew by 4%, you would get a 6% interest credit. The rate of growth times 150, but capped at 9. What would happen under that scenario? Again, you can see somewhere around 5.9 to 6% average annual rates of return over the last 10, 20, and 30-year period, but no sleepless nights here, because you don't have to worry about what's happening in China overnight or Europe, or what type of tensions are happening in China or in the Mideast. When things go bad, zero is your hero. Now, if we look at the history of the S&P, including dividends, over all of the decades going back to the Great Depression decade, 1930 to 1939, you'll notice that even in the Great Depression decade, the market was actually up 40% of the time. 70% during the World War II decade, certainly the market couldn't go up then. In the 50s, 80% of the years the S&P was up. The 60s, the 70s, superinflation here, market still going up 70% of the time. The 80s, 90s, both decades, 90% of those years the market was up. If we look at January 1, 2000 to 12/31/09, arguably what people call the worst decade of investing since the Great Depression, we still had 60% of the time the market's going up. So if we look at this over time as to what percentage of the years in each decade since the Great Depression has the market actually increased in value, you can see that the numbers are very impressive. Again, this past performance is no guarantee of future performance and should not be relied upon as such. It's merely educational. So let's look at riding the ups and downs of the market versus an indexing strategy with an interest growth floor of 0% and a ceiling of 11%. Let's look at the time period January 1, 2000 to 12/31/09, starting with $1 million. If we rode all the ups and downs of the market, by 12/31/09, the $1 million would be worth $909,000. That's why this decade of investing is called the lost decade. It's the only decade where when money would be invested in the beginning of the decade, it would have been worth less at the end of the decade. Now, if we took that $1 million, put it in that indexing strategy with an interest rate floor of 0 and a ceiling of 11%. So again, when the market went up 26% like it did here in 09, you'd limit yourself to 11. But when the market was dipping 22% like it did in 02, 0 is your hero. So under a 0 floor and an 11% ceiling, even during that decade, your $1 million would have grown to $1,589,000, creating a $680,000 difference in the value of your money. But in the indexing strategy, no sleepless nights. Even if we look at this approach under the Great Depression decade, starting with $1 million in 1930, the market dropped 25%. So your $1 million was worth $751. By the end of 1932, the $1 million had dropped to $391,000. But had you not sold out, had you emotionally been able to weather the storm, by the end of that decade, you'd almost would have been back to even. Now, what if we took that same million and subjected it to the interest growth floor of 0 and a ceiling of 11? Even during the Great Depression decade, the million would have grown to $1.5 million, creating a $523,000 difference in the value of your money. But when the market bottomed in 1932 at $390,000, you still would have been at $1 million. Now, under either of these scenarios, we're not considering taxes, investment expenses, or any other charges. It's merely to show you the power of the market versus the power of an indexing strategy for comparison purposes. Now, how about the last 10 years, from January 106 to 12/31/2015? Pretty strong bull market, starting with $1 million and riding the market's ups and downs. By 12/31/2015, your million would have doubled to $2,022,000 riding the market. Again, before taxes and any investment expenses. Now, if we took that same million and adopted the indexing strategy with a growth floor of 0 and a ceiling of 11%, your million would have grown to $1,936,000, about $86,000 short than letting your money actually ride. Again, we're not considering any taxes or investment expenses. Now, again, when we look at the indexing strategy, these kind of severe drops have no impact on principal or any gains. But when the market is running and the market's going up 26% like it did in 09 or 32% like it did in 13, you're capped at 11%. So we're not suggesting that an indexing strategy is a panacea. We're trying to show you why it's an important part of your portfolio. Now, let's also compare riding the market versus an indexing strategy and taking $50,000 withdrawals out of this hypothetical $1 million. So let's say in this example, in retirement. So let's look at the period January 1, 2000 to 12/31/15. We start with $1 million riding the market. We take $50,000 out. We've got $950,000 balance left. The market in 2000 dropped 9%, so the $950,000 dropped by $86,000, leaving a year-end balance of $863,000. So if every year we took these $50,000 withdrawals, in other words, we started with $1 million, we took out $500,000 to live on, and we rode the market's ups and downs, at the end of 2015, the million would be worth $328,000. Now, if we followed the approach of taking the same million, subjecting it to an interest rate floor of 0% and a ceiling of 11%, and we again started with the same million, took the $50,000 withdrawals, and again, interest rate floor of 0, ceiling of 11, we would have ended up with $989,000. Started with $1 million, took out $500,000, and again, with the floor and ceiling, I end up at $989,000 versus the $328,000. Does that surprise you? Now, let's look at doing the same thing, but with a different period of time under a bull market. January 1, 2006, 12/31/15. So if we started with that million and we took out our $50,000, we've got $950 left. Again, this is January 1 through 12/31/06. The market went up 16%, and we had $1.1 million at the end of the year. So we take out our 10 years of withdrawals in this particular example. Again, we're talking about 10 years, 50,000, 500,000 of withdrawals. We ride the ups and downs of the market. At the end of this 10-year bull market, we'd have $1,152,000 left. Again, riding the ups and downs of the market. If we did our indexing strategy, starting with $1 million, and again, taking the withdrawals out, and again, floor of 0 and a ceiling of 11%, we would end up with 1,204,000 at the end of 2015. So in a bull market, taking out withdrawals, obviously the indexing strategy does very well. And you'll remember from the previous slide how much better it did if in the early years you ended up with some very substantial losses. So what we're really doing, looking at this chart in an indexing strategy, and by the way, this chart represents by year. The bars actually represent the growth or loss in the market, S&P that is, and the bottom dots represent the bottom of the market in any given year, how far the market actually fell from January 1 of the year to 12/31. So for example, if I was looking in 1995, from the time January 1 of 95 to 12/31/05, the bottom of the market was only down 3% from January 1. Whereas if you look in this time period here, around 87, the market dropped from the beginning of January by 34%. It finished up 2% that year, but pretty tumultuous ride. So what the indexing strategy is doing is it's smoothing out our returns, and we are basically eliminating any down market movement. So the key questions are, if you could capture between 9 to 11% of all the up markets only, if down markets didn't affect you, and you could lock in the gains, guaranteed by Pacific Life, one of the oldest and largest insurance companies in the United States, if all of the money grew tax deferred under Internal Revenue Code Section 72E1, if money came out tax-free under Internal Revenue Code Section 72E5C, if you had ready access to that cash, if you could have all of that, what percentage of your low to moderate risk portfolio and your annual savings would you allocate to such an asset class? So the reason why we use an index universal life insurance policy issued by Pacific Life are, first of all, those tax-related features where we get potentially tax-free growth, potentially tax-free income, a potentially tax-free death benefit. We've got no Obama or medical or the special tax of 3.8%, no required minimum distributions like in a tax-qualified plan, flexible premiums, and long-term growth potential, again, where we earn interest in part based on the return of the S&P, excluding dividends, but where principal will not decrease due to the market. We get insurance protection, liquidity as well. So in summary, with Index Universal Life, we get, depending on the approach we want to take to what offer of interest crediting we want to take advantage of, interest can be capped at between 9 and 11%. When the market has a down year, you have a 0% interest floor, so no principal or gains are lost. 0 is your hero. And again, repeating, no principal or any gains are lost due to the market's decrease. So we are compounding, never having to rebound, like in 2000 through 2002, when the market decreased almost 40%, or like in 08, when the market dropped 37%. So imagine how you would feel if during these time periods, due to a market downturn, you didn't lose any of your principal or any of your gains. That's why an index universal life strategy is an important part of your overall retirement asset structure. Now, with regards to retirement, and then, of course, talking about retirement planning, how much capital do you think you need at retirement to live the way you want to live for the rest of your life, adjusted for inflation? What do you think is your number? Now, if we look at this chart, if you were a 45-year-old, if your goal was $100,000 of yearly after-tax retirement income, the amount of cash you would need to accumulate at age 65, now this is after tax, not in an IRA, 401k, profit sharing, or pension plan, would be, and this would be based upon getting a 5% rate of return on your money, we're going to assume 3% inflation, and a 20-year retirement period, you would need to accumulate $3.1 million after tax. Does that surprise you? $100,000 a year, adjusting for 3% inflation, 5% assumed rate of return, 20-year retirement period. If you're 45, you've got to accumulate $3.1 million after tax at 65. If you're a 55-year-old today with a $200,000 after-tax annual retirement income goal, your number is $4.6 million after tax. This is Joel Solomon of PRS and the Roadmap. Thank you.